What is up, YouTube? This is the Working Investor. In this video, we're going to talk about triple leverage products and how I'm going to hedge it. And I'm going to hedge it a little bit differently than a blogger named Hedgefundie, but using some of his principles. So let's get into the video. Nothing here is financial advice, tax advice, legal advice, or any sort of advice. And with that said, let's talk about these Hedgefundie. Hedgefundie is a blogger. In 2019, he posted basically that, of course, you can make massive returns, let's say on triple leverage products such as URPO, which is triple leverage S&P 500. But there is a lot of crazy drawdown. So in order to mitigate the drawdown, he basically did a risk parity. So he paired it with TMF, T as in Tom, M as in Mary, F as in Frank, which is a triple leverage long-term 20-year treasury bull leverage ETF. And he started off with a 60-40 split, meaning 60% allocation in UPRO and 40% allocation in this TMF. He started this experiment in February of 2019 with $100,000. And by mid-August of 2019, just about approximately 6 months later, he grew his portfolio $43,000 in 6 months, which is incredible because that's pretty much a 86% annualized return. And at that point, he's changed his strategy from a 60-40 split to a 55-45 split. He does talk about why he doesn't do other leverage funds such as TQQQ. And he does talk about why he chooses specifically TMF versus other hedges such as commodities or, international, etc. But I disagree. I think that, and I did some back testing myself. So let me start getting into it. So first I want to talk about the big risk with triple leverage funds. And I mentioned in the previous video, there's something called volatility decay or volatility drag. And basically it means that you could see here in red that it's a triple leverage product. For example, the green is a double leverage product and the blue is the underlier, which is not leveraged. And you could see that in a cycle where there's choppiness in the market's chopping, but it's mostly staying flat overall, you'd be kind of where you started. But if you had a leveraged product, because of the change in shifts, there's something called volatility decay, you actually would lose much further. Let me show you a great example of this on the 3-year chart on Seeking Alpha. So here on Seeking Alpha, I'm comparing total returns of the NASDAQ and S&P 500 against their triple leverage counterparts. So you could see in the 3-year chart, the TQQQ is up a little more than 20%. The Qs are up about 39% and a bit. So you could see that the underlier, the Qs, outperformed a triple leverage Q. Why? Because of volatility decay. Because you would think that the triple leverage Q should have 3 times more, but no, because they reset every single day. And I have to look into this a little more, but I heard from some people saying that because they reset every day, there's no overnight exposure. You don't get the gap up in the market. That's one part. And also, they reset, they rebalance every single day. There's also an expense ratio, and also what you don't see, you have to look at the prospectus, is that there's also, in order to achieve the triple leverage, they have to use a bunch of stuff like notes, exchange traded notes, and maybe some future products inside of it. And there is like a few percent cost to that as well. So being flat could cost money because of both volatility drag and, some expenses that are built in. So, and here you could see in the 3-year chart, UPRO, which is the triple leverage S&P 500, it's up on the 3-year chart a little more than 28%, and VOO is up 32% and change. So you could see again that VOO, the non-leveraged S&P 500 from Vanguard, is actually outperforming a triple leverage S&P 500. That's horrible, right? We could look at the 1-year chart. Let's look at the TQQQ, almost 10%. The Qs beat them by 11.6 something percent. UPRO 17% and change, VOO 12%. So you could see that so the S&P the triple leverage S&P did perform a little more, but the triple leverage NASDAQ did not. So you could see there's definitely some discrepancies. Of course, if you go to the 5-year chart, you'll start seeing that TQQQ almost tripled the Qs. So you see more of a true part to that. And you could see UPRO more than tripled VOO because it's 571% versus VOO 137. But you see this craziness here with this crazy peaks and troughs. So that's why holding them without a hedge, you know, of course you get great upward momentum up, but you get very, very, very steep declines. And this is why you want to have some rebalancing. You want to have a non-correlated asset with the correlation coefficient ideally as close to zero as possible, maybe even a little bit inversely, or very, very close to zero. And then you could rebalance. So when this goes up and you're doing, let's say, a 60-40 split between the underlier, or whatever kind of split you're doing, whatever kind of risk parity you're doing, of course, when the TQQQ or the UPRO is so high, overweighted, it's time to rebalance. You know, some people rebalance monthly, weekly. I mean, some people do quarterly or yearly. Whatever time you rebalance, just if you rebalance, it keeps you out of this trap where you've taken out profits. By rebalancing, you automatically sell high. And what do you do with the proceeds that you sell? You buy the uncorrelated asset on the low. So you constantly sell high. And then when the markets, when the Qs and the S&P is beaten down, you have overweight now in your inverse fund or the fund that's non-correlated, and you can go ahead and buy more of the triple leverage fund without putting any more money in by rebalancing from the non-leverage fund to non-correlated fund and put them back into TQQQ and buy them at a cheap. And when the TQQQ and UPRO go up, you're going up with more shares that you started off with, so you get that more of an accelerated up. He actually has a chart. In this chart here, he answers the question. You could see in orange, that's UPRO without the TMF, and you could see a little bit UPRO outperforms, but eventually UPRO underperforms when you hedge, when you have the risk parity. You see the blue is his portfolio, which is the combination of TMF and UPRO 60-40 split, and then eventually 55-45 split. And you see how it outperforms. They have much smoother ride and more smoother up and to the right rather than this crazy choppiness. And he said it could take decades to recover from a crazy drawdown. So that's why he mentions this chart. And don't worry, I'll link the article in my description so you guys can read the whole article to the blog post. And here in this chart, he shows the orange is the Vanguard 500, probably VOO. And S&P 500, and the blue is this portfolio with a 60-40 split using triple leverage products, and you could see how it outperforms. That's the idea. You want it to outperform, but you want to have a smoother ride, like I showed you in the previous chart. You want to have this smoother ride without that choppiness down. So here I want to show you why I'm not the biggest fan of TMF. I get the uncorrelated low correlation coefficient to the S&P 500 and very low correlated to the NASDAQ. But let me show you, this is total return, and I'm looking at VOO, which is the baseline. We'll use it as the benchmark. I'm comparing it to TQQQ. I know it's not a perfect thing for TQQQ because that's NASDAQ, but let's just see that to Berkshire Hathaway Group B. And in my other videos, I mentioned why I like it, that it's and I'm going to show you some visuals as well of why Berkshire Hathaway is moderately correlated. Gold, which actually I argue is actually similar correlation coefficient, very subtly different than TMF. VXUS is the Vanguard International, so everything external ex-US, not in the US. And IYR is a real estate index. So you can see here, this is the 5-year chart, total return. So I'm including the dividends, even though it's a little bit, I'd rather have everything added in there. So VOO returned 37%. Of course, you see the TQQ chopping up and down. Again, we spoke about how we're going to smoothen that out by hedging it a little bit and using risk parity and pair it together with something. It's going to be a combination, not a standalone by itself. And here you can see in the 5-year chart, obviously TQQ outperformed. Berkshire Hathaway 189. So you see Berkshire Hathaway outperformed the S&P, and it's moderately, again, use your own risk. Past performance is not indicative of future gains. And look at gold. The reason I'm using gold and not SHNY, which is triple leverage gold, because it hasn't been around long enough, so I couldn't do enough Monte Carlo stimulation. So this gives me an idea, and of course I know SHNY is ETNs, exchange traded notes, that's triple leverage, and they do have volatility lag. and decay, but I'm focusing on the inverse idea, the low correlation. But gold does have some, you see, overall, it does have positive drift. Yes, it's not a income producing asset. It's just a commodity, a precious metal commodity that just sits there, but it's a good hedge against inflation. And it's sort of at least 50% sort of kind of keeps up with the S&P in the past 5 years. And then I have VXUS, which is just right behind gold in total returns. And, that's basically the Vanguard International. I think it's like thousands of different companies, foreign out of the US. TMF, this is why I don't like TMF, because it has overall, I'm looking for something that's, I can do some, some risk parity, but I want something that still has in itself a positive drift, that it's drifting up, ever so slightly up and to the right, not down and to the left. You know what I mean? It's basically going, down and to the right. It's going down. I don't want something that's going to go down in price. I want every single item in itself to go up and have its own rhythm and dance while it goes up. Even if it goes up not as hard, I will take that, but not something that goes down in value. That I don't like that kind of drag in my portfolio. And then IYR, which is the, it's just the real estate index. I'm using because I'm thinking of using Neos's products, IYRI. I don't have enough data, so the best thing I could do is look at IYR, which is its underlying index, which has been around for, about 10 years, more than 10 years, so I have some data. So IYR, 54%. So before we get into the Monte Carlo simulation, so the tickers that I'm comparing is VOO, TMF, VXUS, IYR, to gold, Berkshire Hathaway Group B. So you could see here, I know there's a lot of different colors. So dark blue is basically strongly correlated. Of course, it's a grid, so you'll see TQQQ versus TQQ. Of course, it's a 1. It's a perfectly correlation coefficient, 1. And 1 is perfect correlation, and when you go to 0, it's uncorrelated. When you go to negative, it's inversely correlated. And the light blue is moderately, and as you go to white, it's basically like uncorrelated. So you could see here. Now look over here. Look at GLD, right? So GLD compared to TQQQ or UPRO, you could see it's uncorrelated. It's white, and it's 0.12 correlation coefficient to TQQQ, and it's 0.1 to UPRO. Now, if you go down, let's go down to TMF, which I do not want to do because of the negative drag, negative 88% over 5 years, which I do not like in itself. Look, it has the same, 0.12 correlation coefficient to TQQQ. So it doesn't give me a better, hedge for TQQQ versus gold. And then if you look at UPRO, it does give me a little bit more of a hedge, but we're splitting hairs here. And to get such a horrible, and you could see to everything else, it's not really that correlated, TMF, right? Because except for TMF, it's a grid. But look at gold as well. Go up to gold. Other than gold, everything else also that I want to have as hedges. So not only is it a hedge for TQQQ and UPRO, it's a hedge for all the other stuff that I'm using it to kind of be in the portfolio. So that's why I prefer, that's why I'm playing it more with gold, but actually triple leverage gold, which is SHNY, like shiny. Again, this is just my own personal risk that I'm taking, and I'm not telling anyone to do this. Now you can look at the correlation coefficient of Berkshire Hathaway to TQQQ and UPRO. They are moderately correlated, but not super correlated. And pretty much, they're kind of moderately correlated to everything else. Of course, VOO is like the core position of my portfolio. I'm not going to, I'm playing around with a smaller portion with the triple leverage. VXUS is actually kind of correlated to the TQQ and UPRO, but not as strongly, maybe more correlated than Berkshire Hathaway. So it's not the best type of hedge, but it's something. And real estate is more, moderately correlated to TQQQ and UPRO. Not that correlated to gold, moderately correlated to Berkshire. So it's some of a hedge. I'm trying to find, I found it very hard to find. It's very hard for me to find super low correlation or even negative correlation coefficient, and the thing itself doesn't suck and doesn't underperform. I'm trying to find things that will take something that's mild to moderate correlation, so I know it's not as efficient, but at least it has in itself a positive drift to the upside. It just dances a different way. It just dances offbeat. That's all. So let's look at the back testing, the Monte Carlo. And this is just for illustration purposes. I'm doing something not perfectly like this, but similar. So 15% I'm putting in TQQQ. Let's say, for example, in this experiment, 15% in URPO. Again, it's not exactly, but this is just for illustration purposes. Let's say 5% in gold, or replace it with SHNY, 5% in Berkshire Hathaway, but I'm doing BRKU, which is double leverage Berkshire Hathaway. And now 50%, the majority is just your basic, meat and potatoes, bread and butter, spinach and kale type of, VOO, just 50% of that. I'm not going to use TMF. I just put it in there just as an example. I may use something like CTA, which is commodities. I couldn't use it because it's futures of commodities. I couldn't use it because it doesn't have enough data. It has to have at least 10 years to have Monte Carlo simulation. But I wanted to put it in there to show why I like gold. I'd rather have something like gold in there, or commodities and other types of commodities besides precious metal commodities. And then VXUS, and then real estate. So mine's sort of similar but a little different. And you could see they go through, putting in, I'm starting off the fund with this stimulation, just an example. Let's say you start off with $50,000. Let's say we're talking about 5 years pre-tax. Heck, let's even do 10 years pre-tax. Let's just do 10 years, make it a nice even 10. And then, no adjustments, no withdrawal, no more deposits. It's all a closed system. Let's say there's no fees besides the fees that are built into these funds, but there's no management fees because you're running it yourself. Run stimulation. Let's take a look. So going down over here, you could see 10, 25, 50 percentile, 75, 100 percentile. So you can see the weighted returns, around, let's say, 50, we'll go to 50%, 22%. And then end balance, starting off with 50K. If it's the worst case, if it's a really crappy performance, we're talking about turning the 50K into 128K over a span of 10 years. But 50 percentile will be 375K, which is 7 to 8x, 7.5x. 90 percentile obviously more, but let's just do 50 to kind of be in a middle ground. And you can see here a safe withdrawal rate, 12.14%. There's something called the Sharpe ratio. Very important to know about the Sharpe and the Sortino ratio. These are two ratios that give you risk-adjusted return. The Sortino ratio is a modified Sharpe ratio. So what is the Sharpe ratio? So there's something called risk-adjusted return. For one portion of risk, how much portions of return are you taking? Are you getting a good bang for your buck for the risk that you're taking? If you play a game where you put 100 grand in, you're putting a lot of money in, and your chance of winning is like 1 in a billion, is that worth it? Versus playing a game that you put $100 in and your chance of winning is like 1 in 5. You know what I mean? The different risk-adjusted return. How much risk you're taking for how much return. So it goes from, I think, greater than 1. 1 is good. When you go closer to 0, it's bad. Negative is really bad. So they even tell you, with the percentiles, that's the 10 percentile is 0.45. So if we're talking about a 50 percentile, it's about 0.96. The S&P 500, is about 0.9, somewhere around there. So it's giving you about the same risk, adjusted return, if not better, to the S&P if we're looking at 50 percentile. And then the Sortino ratio is the maximum. It's a modified Sharpe ratio. It's focusing on maximum drawdown risk. And as you go to 1 to 2 is okay. When you go to 2 plus, it's like a lower concern. And when you go to 0 or negative, it's very bad for drawdowns. So if you're looking at the 50 percentile, it's 1.55. If you go to the worst case scenario, it's 0.67. So it tells you basically how to evaluate risk-adjusted return based on the past. That doesn't mean the future. Anyways, I hope you guys enjoy. Let me know what you guys think about this experiment. I'm still tinkering with it. I got a lot more kinks to work out. If you guys have any alternatives, let me know. This is the Working Investor over and out. Have a wonderful trading week.